Okay, good afternoon, everybody. It's tea time. What I want to do is give a short talk on the question, can I afford to retire, which is something that concerns us all, and it's something you need to start thinking about. I see there are some younger members of faculty in the audience, and I think you can get something out of this lecture whether you're 40 years old or 70 years old. And so what I'm going to cover is the following issues. I've been saving all my life. Do I have enough money? What will Social Security give me? What will I spend my money on in retirement? We'll talk a little bit about asset allocation as well. And the other thing is, I'm going to give you a tool at the end of this talk on Monte Carlo simulations, which allow you to build a quite sophisticated model of your personal finances and predict the outcome. Monte Carlo simulations were a technique developed during the time of the, as far as I remember, the atom bomb development to conduct a series of iterations given a set of inputs and look at the likelihood of outcomes. And this is a very powerful tool, and we'll show it and discuss it at the end of the talk. Gray is going to field questions at the end of the talk, and you can best participate by raising your hand if you've got a question, and then Gray will call on you at the end of the talk and act as a moderator. So you got my basic credentials. As well as being an MD and a PhD, I got an MBA from Emory in 1996, and I have experience running an investment fund. I have a reasonable knowledge of statistics. I recently performed the retirement calculations for myself, and I'm now happily retired and hopefully financially secure, and I have nothing to sell. That is the most important thing. We've been reading a lot about racism and unconscious bias, and I think there are unconscious biases in all the people who come and talk to you about your investment portfolio, the people from Vanguard, from TIAA, CREF, and from Fidelity. I think they've got unconscious biases. And although they're not paid by selling you things, they have a potential for bias. So I hope that I will give you an unbiased presentation. I'm going to describe a three-step process for you. I think what you need to do is estimate your expenses first of all, then add up your assets, your savings, your retirement funds, your annuities, and your Social Security, and then do a Monte Carlo simulation and see if your money is going to last you. So it's really aggravating to do this. There are many budget spreadsheets on the internet, and I just pulled this one off at random. I think you need to know how much you're spending every month. How much are you spending on your mortgage, your utilities, your groceries? Go down through your healthcare expenses, your transportation, and then look on the right-hand side at the discretionary budgetary items that you're going to spend your money on. When you're retired, you want to up your discretionary travel. You want to go on that cruise that you've been waiting for, and this will get you started. Work out what your budget is per month in retirement. You know, what are you anticipating spending per month? As Gray mentioned, there is a Emeritus College newsletter on Medicare, and it's worth familiarizing yourself with the convoluted rules surrounding Medicare as you get closer to retirement. It has many parts. The first part, Part A, you're eligible to sign up for at age 65. If you're still working full-time, you don't need to sign up for it. Part B are the necessary services. This is the Medicare supplement, and this you do need to sign up for when you're retiring, preferably starting 3 months before your retirement date. Medicare Advantage are the Medicare supplements. Part D is the drug coverage, and there are other parts. And Part B is actually taken off your Social Security, and that may be more expensive than you think per person. It ranges from $190 to $460. It's means tested. So think about the costs of Medicare when you're thinking about your Social Security. You're going to have Part B dinging you for a certain amount. So what about Social Security? Let's take our example of John, who's a 66-year-old anesthesiologist. He intends to keep working until he's 70. He has plenty of money to retire. He's qualified for full Social Security. If he turns on Social Security age 66, he can draw about $45,000 a year now for himself and his wife. But when he waits till he's 70, he can draw 132% of that when he's 70. So that'll get him up to over $59,000 a year. When should he turn on Social Security? And when do you think you need to start drawing it? So the discussion that I'm about to give you assumes a healthy person is retiring age 66 to 70 with a reasonable asset base, who's not going to be entirely dependent on Social Security for their retirement living. If you've got illness, other circumstances like you're very short of money, you've got three divorces and alimony to pay, and you're going to need that Social Security maxed out, different solutions may apply. But let's walk through this. The full retirement age for Social Security benefits depends on when you were born, and people who are coming up to retirement now, it's somewhere in the 66 to 67 range, and it's going to be 67 if you're born 1960 or later. So that's the age you benefit, you're eligible for your full retirement. Now, if you take your Social Security early, before 66, it'll cost you approximately 0.5% of the amount per month. If you wait until after you're age 66, it'll increase by about 8% per annum. If you're still working, you should wait until at least your full retirement age, or if you turn on Social Security, it's reduced dollar for dollar from what you're earning. So here are the effect of early retirement on benefit. If you retire at age 62, and you may need to do this if you're sick, can't continue working, you will only get 75% of your primary insurance amount, and it gradually increases until 66 when you get 100% of your Social Security benefit. If you delay the effect of drawing the Social Security, as I said, it gradually increases. So if you wait from 66 until you're 70, you get 132% of the benefit. It increases by 8% per annum. So a lot of financial advisors say that in order to maximize your Social Security benefit, you should wait until you're 70. But I have an issue with that. This graph shows the cumulative value of the benefits received. That's just the dollar amount you will receive from Social Security if you turn on Social Security at age 62, that's the green line, at age 66, that's the blue line, and at age 70, which is the burgundy line. If you look out, let's look at the comparison between full Social Security at 100% at age 66 or age 70, then you have to wait until you're about 82 before you've received the same number of dollars from the Social Security benefit. That's the crossover point. And that's not taking into account inflation, taxes. It becomes very time value of money. Let's not think about those things, but just think of the cumulative dollars you will receive from Social Security. Turn it on age 66, you start getting the money at age 66, and it keeps on flowing. And if you wait until you're 70, you'll have to be over 82 years old before you'll have received the same amount of money from Social Security. So ask yourself, what do you want that money for? Do you want age 70 to be going on that world cruise, or do you want to pay for your retirement, for your memory care aged 85? And that'll inform that decision a little bit. So the conventional wisdom is that if you can afford to, you should wait until you're 70 before turning on Social Security. As I said, the crossover point in dollars received is 82 to 83 in actual dollars. What happens if you take that $45,000 at age 66, invested at 5%, after 4 years, you've got $55,000. So that delays the crossover even further. When do you think you need to spend that money? When do you want to spend that money? Do you want to spend it in the years when you're fully active, or do you think you'll need it at the end of life? And that's the decision you need to make. Also, are we going to make 82? Let's have the money now and live a little bit. Let's talk about financial advisors. Most of us have financial advisors who work for us or work for their institution. The first question you should ask anybody who is a financial advisor is ask them, are they a fiduciary? And that means that their advice is required to be the optimal advice for you and your situation. If they are not a fiduciary, then they may offer you advice that maximizes their commissions. So under no circumstances should you work with a financial advisor if they don't say that they're a fiduciary. There was a proposal actually in the Obama years that all financial advisors should be fiduciaries, but that fell by the wayside during the last administration. Ask who they're working for. Are they working for you, or are they working for the investment company that they are representing? There are three ways of paying financial advisors. Traditionally, they've worked on commissions. That is, they'll give you their advice for free. They're not charging you, but they are generating commissions on the products that they sell you. This is a bad idea. They are going to be, even if they're fiduciary, I believe that they're going to be steering you towards commission-based products. You don't want that. You want a financial advisor who is going to work for you on a fee basis. And that means that you're going to pay them $100-200 an hour for doing the work to build your financial plan and to advise you. Some people will work on a hybrid basis, on a lower fee and some commission, but I think you need to talk to your financial advisor, find out if they're a fiduciary and how you're going to pay them. And I recommend a fiduciary who is working on a fee-only basis. Let's talk about what's in your portfolio. You've got your 401k, your 457, your retirement plans, you've got your taxable savings. You've probably got a mixture of stocks, bonds, and annuities. And I want to talk a little bit about a rational approach to investing. By the way, I should have mentioned at the beginning, if anybody wants this slide set, I'm quite happy to share it with them. I'll give you my email at the end, and you're welcome to ping me and I'll send it on to you. Should you hold individual stocks, and should you try and time the market? I don't hold any individual stocks. I don't think we as university professionals have the knowledge to invest in individual stocks. I think the market, although is supposed to be rational, I think it's definitely irrational in the short term, and I'll tell you why I think that. We don't get mansplaining about stock information, we get retrosplaining. So, you know, you see 4:30, the news is saying, well, the market was up 2% today because we had excellent results from Microsoft and Google. Or the market was down 2% because a tanker got stuck in the Straits of Hormuz and they're worried about oil. But nobody will ever tell you this with any reliability in advance of the day. So the information that you get on stocks and shares and what the market's doing is always retrosplaining. I think that we should be investing our money as academics in low-cost mutual funds or exchange-traded funds. Mutual funds are things like the Vanguard S&P 500, Total Stock Market Index, Fidelity and TIAA-CREF have similar products. And exchange-traded funds are available that cover a lot of the same ground, but they can be traded in and out on a daily basis. Mutual funds are priced at the end of the day, exchange-traded funds priced during the day. All the vendors will offer target-dated funds which shift and by target-dated, I mean you set your retirement date at 2030, say, and you put your money into Fidelity's 2030 target-dated fund, and they will gradually shift the asset allocation as you approach retirement to make to move from stocks into bonds. I'm not a great fan of target-dated funds. They have quite high internal fees, and there are one size fits everybody. I think that you, as academics, have some responsibility to look at your own retirement, look at your risk tolerance, and develop a strategy that suits you. Talking about the market, I wanted to look at one thing that happened over the last year and talk about that a little bit. This is the S&P 500. If you look at this is last year, February the 20th or so, it was running at about 3,400. March the 23rd, it had dropped to 2,200. We all know what was going on at that time, but never, not even during the Great Depression, has the market fallen so far, so fast. This is the start of the pandemic, and the S&P 500 loses 36% over a period of a month. Think of that, 36% of the wealth of American companies got wiped out in those 30 days. Huge problem. Why did it happen? Well, on February the 21st, Italy announced the lockdown. It was apparent that there was going to be significant financial turmoil ahead. So there's a flight to safety. Stocks plummet, and dollars went to treasuries. There's a flight to say the treasuries are believed to be the safest investment. On March 31st, in order to stimulate the the economy, the Fed cuts rates to about 1%. Oil prices plummet, investors start to sell treasuries, the treasury yield rises. This has never happened before. People wanted cold, hard cash. They didn't even want to be in treasuries. And this is what's going on here. So what does the average investor who's listening to this talk do at this point? They've just seen 36% of their average stock portfolio wiped out in a month. What's going to happen? We're at the start of an unknown pandemic. Everything's going absolutely crazy. Well, this is what happened. The stock market shot up again. If you look on the left-hand side, that's the graph that I showed you before and is in fact my backdrop for this lecture. The market didn't stay down. Suddenly it shot up by August. It was at the same level as it was in March. But what's going on in the economy? The economy's shut down. Everybody's staying at home. Airplanes aren't flying. People aren't buying clothes. Restaurants and the hospitality business is going under. But the stock market rises. Does that make any sense to anybody? I found this really difficult to explain. And then it continues rising. Well, what happened? Why did it come back so fast and and continue to rise so steeply? It was the Fed. On March the 23rd, the Fed promises to buy an unlimited amount of Treasury debt. They promise to buy commercial mortgage-backed securities. They buy corporate debt and get loans to mid-sized businesses. This has never happened before. In 2008, the Fed was criticized for throwing money at banks to stop the banks going under. This time, they threw money at everybody. And the dash to cash turned around on that day, on March the 23rd. And if the Fed hadn't done that, I would suspect that we would be in a very different situation and be looking at a very different graph from March last year. I think this is really interesting, how external sources which you've got no idea about, cannot predict, turn the market around. Anyway, I just wanted to go through that so that you can get some idea of what goes on in the market when you see these huge catastrophic changes, and then suddenly, for unexplained reasons, they shoots back up again. Anyway, how much should you have in your portfolio that should be bonds or stocks? Bonds are generally more conservative than stocks, and the suggestion, the conventional wisdom, is that at age 40, you should have 40% bonds in your portfolio, and at age 70, you should have 70% bonds, i.e. your age in years describes the amount of bonds you should hold, because at age 40, you've got time for the market to go up, the market to go down. Over any long period of time, the market will go up. But at age 70, if you've got a 100% stock portfolio, you really can't stomach a 50% market decline. So conventional wisdom is that you should have your age in years in bonds. My personal opinion is that that's a little too high. Over a long term, over any long period, stocks will outperform bonds. Stocks return an average of 7% per annum. Bonds return an average of about 4.5% per annum. So over a 5-year or a longer window, you want more stocks. Over a shorter window, because of the stability of the bond market, or the relative stability of the bond market, you want more bonds. So think about that when you look at your stock portfolio. Here is a sample asset allocation model. which suggests that you take all your investment portfolio and allocate it around something like 40% S&P, 10% mid-cap, 10% small cap, 20% international, and 30% bonds. If you don't want to mess with an asset allocation on your own, consider something like the Vanguard Total Stock Market Index. That's returned close to 10% per annum since 1992. But I think it's worth getting yourself down into the weeds a little bit. It's your money, you need it, you want to understand what's going on with it. I am a little unenthusiastic about annuities. They're complicated. They pay you money every year because they have multiple riders about how they step up, how they're guaranteed, do they pay out to your wife, what's the death benefit. They're loaded with visible and internal invisible fees. The value is usually fixed, doesn't go up with inflation, although you can get inflation-linked annuities. The advantage is that they provide some income stability in down years. And I don't know whether you should have them or not. I was sold some years ago, not a huge amount, but they pay me a fixed income. When you're being sold whole life insurance and long-term care, that's another investment in quotes, which has substantial fees associated with it. If somebody's selling you whole life insurance so that you get a lot of money back, ask your salesman to perform a future value calculation for the dollars you're being asked to invest. Say you're being sold $1 million worth of whole life insurance, and you have to pay premiums on that. Ask them to take the premiums, gross that up at 5% per annum, and see whether you get more at the end from investing the money or having the whole life insurance. You'll find that because of the fees and the money that they're taking out of it, you'll have more money just investing in an asset allocation model than a whole life insurance. The other kind of insurance that people approaching retirement are being sold is long-term care insurance. It ties up a huge number of dollars, which you can't get at, and has limited coverage. It will only cover $2,000 a month or $3,000 a month, and it may only cover it for a period of time. I'm not a fan of long-term care insurance. I think if you manage your money appropriately, you hopefully will have enough left to cover long-term care insurance. There's one incorrect financial decision that I made that I actually don't regret. This was my wife. She persuaded me to pay off the mortgage on our house. So as far as I was concerned, mortgages are free money. You're paying interest at around 3.5%, and that's tax deductible anyway. And you can generate more than that by investing the money. However, if you don't have a mortgage, you do sleep well at night. So if there's a catastrophic failure in the market, at least my house is not going to be taken away from me. So consider that. So you've done your expense sheet, and you want to know if you've got enough money to retire, or if you're saving enough money to retire in the future. Roughly, you can take 5% of your total assets, and that's what you can spend per annum and not run out of money, because your investment portfolio on average will grow around 5%. So if that means you've got $1 million saved, you can spend $50,000 per annum, plus your Social Security, plus your annuities or whatever else you've got going on. but that's a quick and dirty calculation. If the market's done particularly well, you can spend more in a good year. If the market's plummeted, you should be spending less. But I'm going to show you a much more sophisticated way of seeing whether you've got enough money or not. Using a Monte Carlo simulation, it is going to give, takes your input parameters and models many outcomes and gives you a probability of success. I would point out that it's only as good as the inputs that you put into the model, and it's available via most financial advisors. If you have a retirement plan, your financial advisor will run this for you, or there are free models on the web. And I'm going to show you one which is called the Flexible Retirement Planner. And if you search on Google or your favorite search engine for Flexible Retirement Planner, you can download it for free. It's quite sophisticated and, as I said, free. I'm going to switch over screens and exit out of the PowerPoint to show you this modeling technique. This is my contact information. I'm happy to share my slides with anybody, and I'm happy to meet with anybody in person or via Zoom for specific personal questions that are not you don't want to bring up in the Q&A portion of this talk. And I know that several people have found that helpful in the past. I'm retired, I've got time. I'll happily talk to anybody about this. I find it quite interesting. So this is the Flexible Retirement Planner. As I said, you find it on the web, Flexible Retirement Planner. So let's start with a youngish person. They are age 40. They want to retire at age, well, most people want to retire a little bit older. Let's move the retirement age to 66. Let's maximize that. They hope they're going to live until they're 95. We're expecting an inflation average of 3%, investment tax rate of 15%, income tax rate of 20%. They don't have any savings at the moment in a taxable portfolio, but they work with Emory, and they've got, say, 150,000. Well, that's 150,000 in their 401k, and the minimum withdrawal age will set for our 401k to 65. Now they're putting away, say, 25,000 a year in the Emory 401k, and they think they need to save some money in taxable savings, and will save $10,000 a year in taxable savings. Their investment style, they're young, and so they're going to go on an aggressive portfolio, which is 70% stocks, 7% bonds, and 23% international. Now their annual retirement income, they're getting money from Social Security, say at 45,000. And how much money do you want to spend in your retirement? You want to spend $100,000 a year. Okay, your spending policy is flexible. That is, you're prepared to spend more money in good years, and if you have bad years, you're prepared to ramp down a little bit. And so I'm going to run this simulation with these inputs and see what the probability of success is. Whoopee. You want the probability of your success to be in the 90s of your Monte Carlo simulation. So they're happy. This person is going to do just fine. But look what happens if you change the inflation rate. Let's change the inflation rate to 5%. Now you've got trouble. So your probability of success is only now 80%. You really want your probability of success in this model to be in the 90s. So I think I would encourage the people listening to this talk to go out, do this model every year as you approach retirement. If you want to die a bit earlier, you'll improve the probability of success. Your money won't need to last so long. So let's drop the life expectancy to 90. That gives you another 5% on the probability of success. Let's spend a little bit less money during the year. Let's spend 90,000 instead of 100,000. That gets us up into the 90s again. And so now, if you die a little bit earlier and spend a little bit less, even with inflation at 5%, then you can then you're going to have a successful outcome. Let's look at somebody who is 60 and thinking about their retirement in 6 years' time. They've got a taxable portfolio value of somewhere around, let's see, 150,000. They've got a lot of money with Emory, and their 401k, they've been saving up for that for the last 30 years. They've got $1 million. They're then still putting away 25,000 and 10,000, and they really would like to spend 150,000 a year. Are they going to be able to do that? What do you think, folks? Let's run that. Oh dear, that is not good. If that's all you've got, you're not going to be able to spend 150,000 a year. You're going to run out of money way early. So if you're in this situation now, then you need to consider increasing your savings or decreasing your annual retirement spending. So let's bump this up to 30,000 a year. That's not going to make a big difference. Made a little bit. The other problem is that you really don't want to run this with the life expectancy of 90. You really want to plan on living to 95. And this is not good. So let's look at decreasing our retirement spending to $100,000 a year and run that. Well, that's looking much better, isn't it? We can with this setup, the person can plan on spending $100,000 a year and make it through to 95 without running out of money. Let's try 110,000 and run it again, and it's fallen down below 83%. But if we're more conservative with our spending policy, it doesn't make much difference. So I wanted to show you this and encourage you all to go out and do this for yourselves. I think it's an incredibly powerful tool. As I said, it's Flexible Retirement Planner, and search Google for it. Here you can show the failures, the time the money runs out. You can get a more granular view. It's the summary view, and and yeah. Anyway, I wanted to show you that and encourage you at the end of this lecture to go out and do it for yourself, because then you can play with it and get to the model that suits you and your lifestyle. I hope this has been useful. I'm going to turn off my screen share for the moment and ask Gray to field questions.
Hi, Peter. Thanks for the talk. Very helpful. I had a question about whether anyone's done these calculations with the crossover point of the taking your Social Security at 62 or 67 or 70, for example, or 66 or 70, and considered what would happen if you took it at, let's say, 62 and you didn't spend any of that money, you actually invested it. And then you started using money at 70, let's say. Do you do better investing those early years at a lesser amount than letting the government give you portions?
Oh, sure you do. But there's a problem with that. First of all, if you start...
Oh, if you're working.
If you're working, if you retire at 62, the problem is if you're working, then you're paying, it's reduced dollar for dollar. So you don't really want to take it until you're either retired or B, have reached full retirement age. And I did have a slide that showed that if you take it at age 66, if you take your $45,000 at age 66 and invest it until you're 70 at 5%, I think you end up with about $55,000 for, so for each year it's less than that. And so that's why I think you should do it. That's what I did. I turned it on at 66 and invested it and put it into my taxable savings. It's a complicated decision because the money that you receive from Social Security is taxable. But again, I think you're better off if you've got a reasonable asset base, turning on Social Security at full retirement age and socking it away until you need it. My philosophy has always been that I'm more likely to need money at the beginning of my retirement than at the end of my retirement. I've done my Monte Carlo simulation. I'm not going to run out of money, and if I need to go into assisted living, then it can be paid for through that. The other thing you can do to pay for assisted living is use your biggest asset, which is your house. If you need to go into assisted living, you can reverse mortgage or sell your property. So yeah, I believe you should, at full retirement age, take the money and run.
One side note on that is, if you have a spouse who's younger than you, and you pass away, do they get your full amount, as in your 70 or 70 amount if you wait till then, or do they just get your 67-year amount if your amount is higher than theirs? Because my understanding is they get to choose either theirs or the deceased spouse Social Security.
I don't know the answer to that. I'd have to go to the Social Security website and look up the answer to that.
I was trying, but didn't get very far. Yeah. Thanks again.
Okay, and I see Carlos has his hand up.
Yes, Peter, thank you. This was great. How about withdrawing from your 403 is whatever? I mean, that money is there, but it's when you withdraw it, it's going to be taxable. So and there's a minimum withdrawal that you have to take at some point. So how do you decide whether you start spending on your taxable portfolio or in your deferred portfolio? And how do you make that balance?
Yeah, that's an interesting question. First of all, Carlos, thank you for all the work you've been doing over the answers you've been giving over the last year with relation to COVID. I mean, you've done an amazing job. Thank you so much. And you put a remark in the chat when I was talking about the stock market, the government put tons of money into the economy. It was free money. They threw money at the economy in a way that has never been seen before. I mean, it was incredible. So when do you turn on? When do you withdraw from your taxable portfolio? When do you withdraw from your deferred portfolio? It depends what your tax rate's going to be to a certain extent. Generally, people's tax rate declines as they get older and have less money. The tax rate has fallen over the last 4 years with the Trump administration. And if you think about it this way, your tax deferred portfolio has around a 30% bonus in it. As you put that money away, the government is essentially giving you 30% by tax deferring that amount. And that is compounding every year. And the value of compound interest means that that's going to grow bigger and faster than a tax deferred, than a taxable portfolio, portfolio of taxable money. So my impression is that it's better to deplete your taxable portfolio first and continue to allow that tax deferred portfolio to grow. But the problem is that you're going to run into something called RMD, which is retired minimum distribution. And the government doesn't want you dying on your sword, age 95, with your tax deferred portfolio untouched. So they require that you withdraw an amount age 72 from that portfolio every year. And you have to start withdrawing it, I think, in the by April of the year after you turn 72 is when the first distribution has to be taken. So to answer your question, take the taxable, draw down the taxable portfolio first, defer the tax deferred portfolio until at least age 72 if you can.
Thank you.
And Ashley has a question.
Hey there. The Monte Carlo situation that you displayed, does that include Social Security?
Yeah, it does. I put up on there, let me just bring it back up again. Hang on, no, I need screen share first, sorry. If you look over in the right-hand column here where my cursor is, it says annual retirement income. That is what I'm setting as the Social Security. I assume that I'm going to get Social Security and no other income in retirement. So you can put your Social Security there, or you can add in your annuities or whatever you like into that cell. So yeah, you can put in your Social Security there.
Would you recommend that from our Social Security statement that we put the full amount that it says that is projected, or should we lower that amount, maybe 70% or 50%?
I'd put the full amount in. I mean, I don't think Social Security is going to go away. I mean, there's a lot of fuss every now and then about the Social Security Trust Fund running out. I don't think any government that allows the Social Security Trust Fund to go bankrupt is going to get re-elected in the next 50 years. I think it's reasonably secure.
Okay, thank you.
Hi, thank you. With international companies representing approximately 50% of the global economy, is there a simple reason why international stock allocation is only 20% in your little model?
Well, the international companies are highly represented in the US stock market. So you're buying those international companies when you invest in the S&P 500. I think that the problem is that the international, where do you live? You live in the United States. You're not living in China. If you're living in China, then you want your money to be tied to China and to go up and down with China's economy. I think that the international stocks have generally been a little more volatile. It depends whether you go with an all stock index or whether you go with some of the more specific emerging economies. I think most people who describe asset allocations for people living in the United States recommend only about 20% international stocks. And, I don't have a strong feeling either way. You can overweight it if you want, you can underweight it. I just showed you a sample allocation. It's up to you what you do with it. If you think, well, I really think China's going to be the powerhouse economy, then consider investing in a Chinese specific fund rather than just a general stock market fund. But I do think that all the funds that you invest in should be passive. They shouldn't be actively traded. You should be looking for something that tracks an index, either a specific fund or an exchange traded fund that tracks an index. And you can fiddle with that stock allocation and bond allocation to your heart's content. I'm 70 years old. I only have 35% of my portfolio in bonds. That's a choice I took. Other people will have much higher percentages. It depends on your risk tolerance. Can you afford another 30% downturn in the stock market? You're going to have to sell your house because you kept your mortgage if the stock market falls 30%. It depends on your risk tolerance. Yeah.
Thank you.